Good morning, everyone, and thank you very much for joining me. This is the Morning Market Review. It's Tuesday, it's the 6th of December. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address is ash@fxcm.com. Just bringing up the high risk investment warning. Can I just confirm that you guys can see the screen and hear me? Just want to double check. Can you guys hear me and see the screen? Okay, cool. Thanks, Shadrach. Okay. Hey, Howard. Morning to you. Let's just go ahead, bring up the market commentaries disclaimer here. Okay, here's our references: Market Scope, Trading View, Forex Factory. I've left out Bloomberg. We're just going to go for about 15 minutes this morning. I'm begging your pardon. So I thought we'd leave out the Bloomberg email for today. Let's just go through to Forex Factory. Just wanted to show you overnight the RBA has increased interest rates from 2.85% to 3.1%. Right, I've got Kuba saying he can't hear me. You guys can hear me, right? I've got a confirmation from Shadrach and Howard. Kuba saying he can't hear me. You can, yeah. Okay, excellent. All right. Let me bring up this chart over here. This is an interesting chart that I thought it's worth us taking a look at. This is the 12-month. I beg pardon. This is the monthly real rate, but underneath we've got the 12-month. We've got the 12-month wage rate of change. Here's the 12-month rate of change. I'm actually going to put on the camera. Keep forgetting to do that, but I think we can do it now. I think it makes a difference if the camera's on. And you can see what the issue is with the rate of change, right? You've got this kick up over here. Okay? Got this kick up right over here, and that's the issue. In that, if we bring in another inflation reading here, so let's bring in the median. So I'm going to just bring in the median CPI, which is my preferred measure of looking at the looking at inflation, because it's taking a look at the sticky elements, right? So if we take a look at the US CPI median, we add that onto the analysis here. What you effectively have is actually quite a good looking chart, relatively speaking. What do I mean good looking? Well, it's starting to taper. Okay, so you've got this really good looking turning point. This looks like it's going to be a parabola. It looks like we've got the turning point here. What's the complication? It's that wages has kicked up, and that makes very little sense. That makes very little sense, in that the median is starting to taper off and you've got the wages kicking up. What I suspect is that this may be an outlier. Now, I can't say that for certain, but I think if the median inflation is showing signs of tapering off, then a wage spiral to me seems less likely, of course. Now, the worst thing that could possibly happen is a wage spiral effectively sets in. If we get a wage spiral that sets in, the Fed is going to go guns blazing. It's going to raise rates to much higher levels than previously thought, because what a wage spiral effectively does, it entrenches and effectively pushes inflation up. I go to my manager, I say, I want more money. So now there's more money from me in the economy. I'll spend more. That's effectively feeds into other areas of the economy. If I go into, say, a store and buy goods, they will see that there's demand pressures. So there's demand pull. Okay, demand pull inflation pushes up, and well, things become more expensive. So I go back to my manager, I say I need more money because my standard of living is dropping. So then I go back and I buy more, and then the retailer or whoever I'm buying from sees that there's demand, and that pulls the inflation up. So you've got demand pull versus cost push. So a wage spiral, once it becomes entrenched, have we had a wage spiral before? I think there have been cases of wage spirals. I need to actually take a look historically, Gertie, just to pinpoint exactly when it was. Central banks are incredibly fearful of wage spirals. They typically take place in hyperinflationary type of economies. So a wage spiral, I mean, talking in terms of extremes is never really the right way to make a point, but just going through to, say, Zimbabwe, which is an extreme case, and of course it's not anywhere closely linked to the US, but that there would have been an entrenched wage spiral. You would need to have a wage spiral because your inflation was just running at ridiculously high levels. If we had to go back in history, you know, after World War I, the Weimar Republic, that had a wage spiral. It's very, very damaging because it sits in almost a hyperinflationary type of scenario. There's no ways the Fed lets that happen. If wages do not cool down, they're going to have no choice but to increase interest rates aggressively, and that's a pity because we've seen the median inflation tapering off. In other words, we had a really good story starting to develop, and we could have started talking about, well, have we bottomed? Have we bottomed? And I would suggest that the wage story here, I'm going to suggest, is perhaps we take an optimistic view and see it perhaps as an outlier until we get the next data point. The next data point is going to be the non-farm payroll first Friday in January for the December period. And even the December period has some sort of seasonal anomalies to it, doesn't it? So there's going to be perhaps even a lag to February. And if we wait till February, perhaps we get a more realistic type of idea. And I think that that's an important point to make, in that the kick up in inflation on Friday, perhaps policymakers are worried about it, but I would suggest that they need at least another 2 months to really become hugely concerned about it. And that's something that I haven't really heard much about in the media. On the contrary, what I've heard in the media is that this is trouble, this is trouble, this is trouble, this is trouble. And yes, of course, it may be trouble, but one data point doesn't make a trend. So we've just got one kick up here. Okay, we don't have a trend yet. In fact, it was trending down. Okay, the rate of change was actually trending down. Now we've got a kick up. And we can see we have had peaks and troughs in the past. So I would suggest that perhaps we take an optimistic view of this, and that any pullbacks in the risk markets, we actually look at very, very carefully to see if there is in fact opportunity for us to exploit, and see if there's some money to be made. Gertie's just writing, are unit costs of labor less important now to overall costs? Can you just perhaps flesh that question out, Gertie? I'm not sure I'm fully appreciating the question. Are unit costs of labor less important now to overall costs? I think that the issue with labor is not per unit costs only. Whilst per unit cost is, of course, extremely important, you don't necessarily need to control the per unit cost, because you can control the number of units, right? In other words, if the per unit cost gets too high, you cut back on your units. Well, that's unemployment. That's unemployment. And so I don't think it is less important now. I think it's just as important. But I don't think that it can be sort of an isolated analysis. I'm hoping that I've kind of answered that question. Let's just take a quick look. Cost of labor is now less important to overall costs. Okay, so Gertie, I think you're making a statement there. So Gertie saying the cost of labor seems to be now less important to overall costs than say 40 years ago. Yes, I would agree with that. And I'll tell you why I agree with that. It's because it depends which economy we're talking about. But if it's in a labor-intensive or a capital-intensive country, the costs would be very different. In fact, for economic growth, the real focus would be on costs of technology, okay, in your capital-intensive countries. So that's really if your capital starts becoming too expensive, well then you've got a real problem. So that would be something that would be, I think, more important than say 40 years ago. I would agree with that, Gurdeep. Pricing power of labor has reduced dramatically. Yes, I think that is. I think I would go ahead with that as well. I think I would agree with that, which is of course the reason unions exist. You know. All right. Let's just take a look at this chart here. Okay, so I'm going to just change it up. This is Bitcoin, but I don't want to take a look at Bitcoin. We'll do Bitcoin tomorrow. I just want to take a look at the US dollar. Okay, and you can see that the US dollar actually showing signs of strength yesterday. Okay, but take a look, it's actually positioned. It's actually positioned in zone 3, isn't it? It's not positioned in zone 2. It hasn't moved from zone 3 into zone 2. So there's no relative strength here. In fact, so what I'm suggesting is, well, if we take a look at this from an optimistic point of view, is this perhaps some sort of rally that we can take advantage of? Let's take a look at, say, the euro over here. Okay, euro came down quite heavily. Is this perhaps a dip? Is this perhaps a dip that we can take advantage of? Again, a lot has been said about, I just want to reiterate sort of the point, a lot has been said about how dangerous the wage spiral is. There's no wage spiral at the moment. The trend's actually down. There's been a spike up. There's no ways that the Fed will let a wage spiral take place. And of course, they'll be watching that kick up, because that kick up was actually, it was quite a fair surprise. On a month-on-month basis, the forecast was for 0.3. It came in at double that, 0.6. So that's a big upside surprise. But again, 1 point's not making the trend here. 1 point's not making the trend yet. And I think, okay, we're going to have at least to wait 2 months to get an accurate view of what's going on with wages. Number one, because December is going to have a seasonal bias to it. And number two, I think we're only going to get the real reading after February. And there might even be some sort of, instead of a bias, there might be some sort of prejudice to February's, because January is probably going to be a slow month anyway. So you can see that it's quite a difficult time of the year to come up with some sort of data points. They're going to have to be seasonally adjusted. All right. With saying that, the obvious question is, are there dips in the uptrends we can take advantage of? Are there rallies in downtrends we can take advantage of? I'm going to close out here. If there's any questions, please go ahead and type those in. Any questions, go ahead and type those in. From tomorrow, we're going to go back to full webinars, except tomorrow we are going to have the morning market review, and then we're going to go through to our crypto minute. All right, I'm going to close out here. There's no questions. I'm in a very, very noisy environment. I duly apologize. From tomorrow, we're going to be back to normal. Thank you very much, guys. Have a good day, a good evening ahead, and we shall chat on the morrow.